Okay, I think most of us are now here, so we shall commence the meeting. Thank you so much to all of you, partners and friends, for joining us today for our Mayar Capital Annual Investor Meeting 2020. I just want to start by saying we're so happy to see so many of you from across the globe. Obviously, no location limitations this year. So as most of you know, we do usually run these meetings in person. And although not possible this year, we are so thankful that we're still able to meet with you, albeit in a slightly different format, although I would imagine most of you are very used to Zoom by now. It would be remiss of me not to acknowledge the situation that we're all in at the moment, and we would like to convey that our thoughts have been with all of you and your families during this extremely challenging time. And we would also like to sincerely thank each and every one of you for your continued support and trust. We're going to commence shortly by hearing from the team, and we will then move over to a Q&A session. We will, of course, do our utmost to answer all questions during this time. However, if we do run out of time, please do email any questions over afterwards to info@mayarcapital.com, and we will ensure that every single question receives a response. During the Q&A session, you can ask questions by either pressing raise hand, which will enable you to speak, or by using the Q&A button to send us a question at any time during the meeting, which we will then answer during the Q&A session. Just to clarify, you will not be shown on video for either option or at any point during the meeting today. Now, as there are so many of us today, we have auto-muted microphones, which, as I'm sure you can appreciate, is necessary for the meeting to run smoothly. You will be prompted to unmute your microphone if asking a question verbally during the Q&A session. In a moment, I'll be handing over to Mark for a strategy overview. This will include our partnership principles, investment philosophy, investment strategy and process. Mark will then outline any change in AUM during the year. He will then hand over to Aziz for a performance review. Aziz will discuss our year-to-date performance, holdings, asset allocation, performance attribution, and changes to the portfolio. And Aubrey will then talk about some of the steps that we took early in the pandemic to ensure the robustness of our companies, and we'll then discuss some of our holdings and how they've been impacted by COVID-19. Our new COO, Stefan Davidovsky, will then briefly introduce himself and provide a business update. Stefan will speak for a few minutes about the operational changes implemented this year and give you an overview of any operational changes that we're working on going forward. After Stefan has spoken, we'll move into the Q&A session where we look forward to answering your questions. And we will also be covering some pre-submitted questions during this time. So as I mentioned previously, if you want to ask a question, simply press the raise hand button to speak or the Q&A button to write a question. You should be able to see both options at the bottom of your screen. We'll be sending out a recording of the meeting to you all afterwards, as well as a small gift, and Mark will tell you a little bit more about that later on. That's about everything from me. Thank you so much, and I will now hand over to our Head of Investor Relations, Mark.
Thank you, Sophie. I hope everyone can hear me. Sophie, can you give me a thumbs up if excellent. Well, firstly, I'd like to echo Sophie's sentiment in welcoming you to what is the first fully online Mayar Partners meeting. I'm sure we've all been making greater use of communication technology over the last few months, and in some cases, there have been benefits arising from this new way of working and living. However, as Sophie mentioned, in this case, we would much rather be speaking to you in person and catching up at the post-meeting reception. And we look forward to the time when it's possible to meet you all again face to face. Now, there's no doubt that the events of 2020 will live long in the memory. The COVID-19 pandemic has caused us all issues personally and professionally to a greater or lesser degree, I'm sure. The email greeting, I hope all is well, has taken on a new significance, and Mayar's #1 priority has always been that the loved ones of our team and our partners remain safe and well. We've also felt that professionally, at least, to navigate these seismic events, one must have an existing framework on which to rely, to act as a compass to guide us through stormy times. And what's guided us through these unprecedented times are the same things that have been the pillars of Mayar's success since 2011, namely our partnership principles, the investment strategy, and the philosophy and process. By using these frameworks, it's possible to make better, more consistent decisions at all points in the investment cycle, but particularly in times of high uncertainty. For example, our partnership principles, which should be viewed as a kind of constitution governing the relationship between Mayar and its partners, starts with straight talk, the commitment to communicate regularly and in a straightforward manner. Now, normally our monthly fact sheet and Aziz's quarterly letters give our partners the information that they need at the frequency that they require. However, during the pandemic, we felt it was important to give investors the opportunity to understand what we were doing, how we were reacting at the heart of the market volatility. And we did that through a webinar. Some of you would have joined that. It was a very similar format to the one that we're in today. And in that webinar, we were able to outline our views and the actions we were taking. One of the actions and one of the points raised was that Aziz was, to use his phrase, going all in into the fund, into global equities, in line with our call that it was a good time to step back into the market. Now, this wasn't because we were calling a bottom to the market at that moment, but Aziz and the team felt that 5 years out, the businesses in which the fund were investing were likely to survive the pandemic and be thriving for the medium to long term. At that moment, there were also available significant discounts that we believe to be their intrinsic values. Now, we think this reflects both in it together, where possible, we invest alongside our partners to ensure that our experience is your experience, and also the focus on the long term. It's relatively easy to be a long-term investor when markets are trending upwards, but I've seen many times throughout my career that when volatility rises, long-term investors seem to, their investment horizon will shrink till the end of the week, or in some places, the end of the day. And as you will hear later from Aziz, the consideration of risk before return is paramount, and it is that which guides our investment strategy. Now, the purpose of the investment strategy is not to eliminate risk entirely, but instead to be sure that the risks that we take are deliberate. And we believe this can be achieved through the consistent identifications of great businesses, which are housed within great companies that we can buy at great valuations. And it's important to make the distinction between these elements, as they're not always present simultaneously. You can have a great business that's inside a great company, but alongside other businesses that are not as strong or not as consistent with Mayar's ethical values. Or maybe those businesses have strong customer economics, but with a poor management team. Or maybe those businesses are great and are housed within great companies with strong management teams, but we can't buy them at the valuation that we find attractive. The important thing to remember is that any one of these elements can change, and when they do, we need to be ready, having done the work, so we can act decisively at the appropriate time. And during the pandemic, as with other shock events, it's important to be able to separate the noise from the signal. The 24-hour news cycle coupled with social media generates a lot of heat, but very rarely so much light. The way we navigate this is threefold. The first is to take what we call an ethical owner approach. Remember that we're investing in businesses rather than equities, that we're investing in companies rather than the stock market itself. And remember, we want not only to invest in businesses that are able to generate returns, but we want to do so in a way that is consistent with both our investment principles and our ethical principles. And for Mayar, the ethical and investment aspects are indivisible. We also use the learnings from behavioral science, because as the external influences that impact our behavior and our subconscious biases can tend to rise in periods of stress and periods of high uncertainty. To dampen the effect of behavioural biases, it's necessary not only to be aware of that, but also to implement tools and processes to combat the effects. Industries such as medicine and aviation make use of checklists to ensure good decisions in times of high uncertainty. And the checklist at the heart of our process is designed to ask ourselves consistent questions across sectors, across geographies, and in different market conditions. We also believe that it's important to be humble enough to understand it's impossible to make super precise forecasts. I'm sure it'd be comforting for you if I were to say, or the team were to say, that our stock has 22.8% upside that will be realised at 347 on the 25th of October 2021. The fact is that would be a false comfort, and these sort of false precisions and forecasts tend to make us overconfident in those forecasts. Instead, we try to think probabilistic. That is, try to understand the probability of outcomes within certain ranges. Ranges when it comes to valuations that we're happy buying, holding, or selling the businesses that we've owned. Now, you've heard about me mention ethical values over the last few minutes, so I thought I'd spend a few seconds on what that means and how that's integrated into the investment process. For us, environmental, social, and governance, ESG investing is simply a new way of describing something that's been at the heart of Mayar's process since inception, which is net risk management. Businesses that don't operate in a way that are consistent with our values, we believe, are also likely to be impacted by other influences, such as legislators, consumers, or within their own workforce as well. That could be a reliance on finite resources, like commodities, products that have a negative social impact, or just poor governance practices within businesses. We believe those business models are not sustainable over the long-term investment horizon. And so we allocate capital away from those businesses and towards businesses that we believe will endure for the long term, playing our small role in encouraging best-in-class practices. For some businesses, they operate in sectors that mean that we can exclude them from our universe immediately, thinking alcohol, gambling, tobacco, weapons. However, in permitted sectors, the line is between what is consistent with our values, what is ethical, and what isn't always as clear. And we want to understand if a business is sustainable. This is why we believe it vital that the ESG element of process is fully integrated into our analysis. And this is not only the case at the initiation of an idea and before it goes into the portfolio, but also an ongoing exercise as well. Deterioration of any ESG element could, to use what I accept is a non-ESG friendly metaphor, be the canary in the coal mine, signs of stress elsewhere in a business. And we believe that the consistent application of the partnership principles, the strategy, and the philosophy and process is what has underpinned the success of Mayar and you, our partners. We think this has been reflected in the AUM growth we've seen over the last 12 months. Increasing assets benefits all investors as the economy can drop down into straight through to your return. And we'd like to take this moment to express our gratitude for your continued support, both throughout the years and particularly through these difficult times. We hope to cultivate an investor base that thinks on a long-term basis in the way that we do. And it's as I say, we're incredibly grateful, and it means a lot to us that you've chosen Mayar as stewards of your capital. And we look forward to more success in the future. So at this point, I'll hand over to Aziz, who'll be able to put some numbers on the last 12 months, and he's going to detail some performance and positioning and some outlook.
Thank you, Mark. Good afternoon, everyone. Thank you so much for joining us. I want to echo Mark and say it would have been amazing to see you once again in person. But the reality of this year is that we've got to do what we can. And so I hope that this modified format gets us at least close to what we used to have in terms of our annual meetings. Let me start with performance. Year to date, net of fees, Mayar Fund Class A is up 2% until the end of July, compared to a loss of 1.3% for the MSCI World Index. That brings performance since inception until July 31st to 144%, compared to 107% for the MSCI, an annualized rate of 10.2%, 2 percentage points ahead of the MSCI. That means that $100,000 invested at the fund's inception would have grown to $244,000 at the end of July, compared to only $207,000 if invested in the MSCI. But I also want to point your attention to what are called capture ratios. You can see that little table at the bottom left of the chart in front of you. They tell you how much the fund goes up in a rising market and how much it goes down in a declining market. So the way to read it is, for example, we've captured 94% of up moves. So when the market went up by 10% in the past, on average, we were up 9.4%. And whenever the market was down 10%, we were only down by 7.8%. That's a 78% down capture ratio. The spread between these two numbers is how we outperform. In a sense, you can see that we have been winning by playing defense or winning by not losing. Given the choice between the tortoise and the hare, we like being the tortoise. Slow and steady wins the race. Now let us look at the next chart where we have the contributors to the returns year to date. At the top two are UPS and Vestas, which are also our two largest holdings. And they're followed by two positions that we actually bought during the market decline, Ashtead and UPS, and SAP. And you can see how well they've done since then. The bottom chart shows you the largest contributors to losses. The biggest one is Nordstrom, which is the long-term holding, and Aubrey will talk about it later in this presentation, followed by Discovery and Richemont. All of them are high-quality holdings that have suffered during this pandemic. Let's look at the quality of our portfolio, though, collectively. So we use something called the Stockopedia Quality Score to get a score for each one of our holdings. And then those are benchmarked against the overall universe of global equities. And you can see each one of our holdings and how it compares to the average score of 50. And you can see that what we own is a much higher quality, is a collection of much higher quality businesses than the average company. Now, we believe that the quality of our holdings, together with our valuation discipline, cause our portfolio to be more defensive. Let's look how that translated in past episodes. So if you look at previous periods in this chart, and we've gone back even to the global financial crisis, which was in my predecessor fund, you can see that our portfolio has significantly outperformed in down periods. And that protection of capital is very important because it gives us the capital and the ability to redeploy into attractive opportunities that present themselves during such opportunities. Now, we looked at the Citywire peer universe performance over the past 5 years. You can look at this chart now, and you can see we're at the top left quadrant with higher returns and lower volatility, volatility being a proxy for risk. Now, that means that Mayar Fund is ranked 15th on a risk-adjusted basis in this universe of 2,525 funds. And of that top 20 best performing funds in that group, only 3 of them are ethical funds. Now let's look at our current portfolio in greater depth. First, I want to mention the importance of having high active share. 2 years ago, we presented academic papers in our annual meeting that showed how managers with high active share outperform the average manager and the market pretty much consistently over time. And I don't want to dig too much deeper into this and come back, but I just wanted to emphasize the importance of choosing a high active share manager whenever you choose an active manager. Let's look at the next table. So the next table will show you our activity year to date. Now this was perhaps our most active year ever, especially because a lot of these trades that you can see have happened in a period of a few weeks, towards the end of March and early April. So basically when the markets went down at the end of the first quarter, we went shopping, which is what you should expect us to do. So, and then you can see that trailing towards the end of that chart, as markets recovered, certain stocks that we owned started to trade above what we think is their fair value, and we started to either trim or exit them fully because of that, maintaining our valuation discipline. Now, if we look at our cash position, and this chart goes back all the way to inception, I want to point out 2 things. One is that it changes, obviously, from time to time, and which is a function of the opportunity set that we see in the market. But perhaps more importantly, I want to point out how quickly, and you can see those sharp moves, we are able to deploy capital when opportunities present themselves. The reason we are able to do that is back to what Mark was talking about in the strategy section, which is we often identify a great business and a great company well before it's trading at a great price. And so by building this wish list of companies that we want to own globally and deciding beforehand how much we want to pay for them, that puts us in a position where we can act very quickly like we've done in March and April to take advantage of opportunities when they present themselves. Now, I also want to point out that we're not sitting here and kind of trying to decide at a macro level what level of cash we want to have in the portfolio. Instead, we follow our process. When there are a lot of cheap things to buy that are of high quality, the cash will go down as we deploy that cash into those opportunities. And when our process tells us that we need to sell something that we own because it's gone up in price above what we think is fair, the cash will go up. And it's at the intersection of these two forces that the level of cash is determined. So in a sense, the cash is the output of the process as opposed to one of the inputs. Now let's look at the current portfolio allocation. First, by our preferred measure of where geographically our company's revenues are coming from. And you can see that we're broadly diversified globally. Now looking at the country of listing at the next chart, on the next, can we, next chart please? Yeah, here we go. So if we look at the country of listing, what I want to point out, and this has been moving for a while now, and it's accelerated actually the past few weeks, is you're going to see that the United States as a percentage of country of listing of our portfolio has gone down, and Europe has gone up. And actually Europe is now approaching the size of the US in our portfolio. And that's, again, it's a function of our process. It's where we're finding opportunities as we seek them globally. Now, finally, I want to just point out the distribution of industries in our portfolio. I just want to say that you'll see that we're broadly diversified across many industries. Now, here's our top 10 at the end of July. We continue to have what is a concentrated portfolio, as we've always done. And you can see that collectively our top 10 make up 56% of our portfolio. Now, I'm going to hand it over in a minute to Aubrey, who will take you through some of our investments and show you how they've done this year, but also talk a little bit about things that we've learned through this process and how we've kind of improved our process to ensure that we have a portfolio that's robust and improved our understanding of risk in an environment like this. So off to you, Aubrey.
Hi, good afternoon, and thank you for joining us. Okay, so we're going to start just by looking at a few things that went well and what didn't, and we're going to start with the stocks that I talked about this time last year. And two of the stocks I talked about, Nordstrom and Vestas, turn out to have been our best and worst performing stocks over that pretty much time period. So, Nordstrom, well, who'd have thought that a retailer would do really badly in a pandemic? But the thing is that, look, last year I was telling you that I believe that this will be the category killer in its sector, and I still believe that. And the trouble when you have a thesis like that and you're watching the competitors fall by the wayside, shutting down capacity, is that the time you really want to be selling? Well, not really, because that is what has to happen for the thesis to play out. But we have seen sales down 40%. Yet at the same time, they've managed to reduce their cash burn, also by 40%. They've managed to take 800 mil revolver as well as 600 mil of new debt. They've stopped dividends. They've stopped buybacks. And digital has now become 54% of sales. So they have taken all the right actions that we would expect and that we want to see, from them. And now we just have to wait to see whether our thesis really does play out. Vestas, on the other hand, has been very successful. I really don't need to say a huge amount about this. Revenues have gone up by about 40%. Profitability has been, somewhat muted, and that is really just because COVID has created a lot of issues, with the supply chain. it's made things a bit more difficult. But the more they install, the more service business they get. Again, so look, it's just the thesis is just playing out. If we could have next slide. So at the beginning of this, and I think I talked about this, the last meeting at the beginning of COVID, we really looked at the liquidity, of the companies in our portfolio. And there are several things that we looked at. We looked at the defense interval ratio, the quick ratio, and adjusted quick ratio. We looked at how much short-term debt they have compared to cash. And we looked at, I worked out how far revenues could fall before they would breach covenants, factoring in their fixed costs and their variable costs. Now, as you can see, a sort of slight slide there. I put companies that we don't own because, well, the companies we own are slightly less interesting to look at because it's all clean. Now, for us, this is really important, especially when, I mean, we have seen companies report 90% revenue drops. This is quite stagnant. I've never seen anything like it, and hopefully I never will again. But when you have something as extraordinary as this, the only thing the company is going to be able to rely on is its balance sheet. And the question that I'm asking here to start with is, look, can you survive? So the defense interval ratio, this is, what is the ratio between the net available current assets, so your cash, your short-term receivables, short-term investments, divided by your fixed costs. And we try and make adjustments there for what is actually fixed and what is variable. And what we found is that a lot of our companies could survive for really quite a long period of time. And this is one of the reasons that we liked the house builders, because for them, it was very easy for them to just to switch off, as it were, to go into hibernation and survive for a very long period of time, which gave us a lot of confidence in the operational security of those businesses. Now, we do also have to ask ourselves, were we right to be so risk adverse? Because, the irony is some of the worst businesses we have seen have actually been the best performing, as people have issued new capital and people have lent money and bought equity from businesses that we think are very, very risky. And should we have done that? Well, with 2020 hindsight, we would have made more money, maybe, but would have taken on a level of risk that would not have allowed us to sleep at night. We want to put, it's in the partnership principles. We think of risk before we think of return. And as I say, if for no other reason than I like to sleep at night. So if we could look at the next slides, please. Another stock that did not perform as well as we thought was actually LabCorp. See, now this is a testing business, medical testing. So you sort of would have thought maybe, this would do incredibly well in this environment, especially given, Donald Trump saying how the US are testing more than anyone in the world. And he's more negative or positive. Well, okay, no, I'll stop there. So look, the trouble is LabCorp's core business declined 21%. This is because you're not getting your tests for glandular fever, for all the other things, when you're not going to hospital because of the lockdown and the pandemic. So as I say, that core business did decline 21%, but that was offset by COVID by 15%. And this sort of highlights what we see in just every business we own. You see a decline here, you see a corresponding offset here. Overall though, we saw core earnings per share down 12%. Guidance is still withdrawn, but the outlook has improved. And we're really confident now, perhaps more than ever, because if we think back to what our original investment thesis is, there's this survey which I've charted there. 72% of hospitals do not yet outsource laboratory testing. Now, when the economics for the hospital are so compelling that they can get for 15 to 20% cheaper, they can perform their testing for 15 to 20% cheaper if they use LabCorp. We really believe that this is something that can that should drive growth. And one of the things that you see with COVID is COVID has become a catalyst for a lot of change, whether it's online purchasing or whether it will be outsourcing for hospital lab testing. we think that this gives it a long runway for growth. And at the moment, we're paying 13 times EBIT and a 6% free cash flow yield. So, we're pretty comfortable here, even though counterintuitively, this hasn't done as well as we'd hoped to begin with. If we could look at the next chart. So what has gone well? Well, fortunately, UPS went well. We can see that US volumes were up 23%, but again, we have an offset in B2B declining by 22%. That being said, overall group revenues are up 17%. But the offset to this is also that the price per item is much, much lower because people are sending everything. So now you're not just sending big things, you're sending tiny things. So profits are only up 7.4%. Now, another business that we think has got a really great future and we're really excited about is Electronic Arts. So to give you, brief refresh on our investment thesis on this, firstly, games improve over time. So unlike other art forms, games actually can get better. 5 years from now, games being produced then will be better than computer games being produced now. That's not the same for movies. We're probably never going to get another gangster movie that is better than The Godfather. We're probably never going to get a guitarist better than Hendrix. But with games, you're always going to get better. And not only that, games are the lowest cost entertainment per hour. So Activision, one of EA's competitors, actually worked out what is the cost per hour for entertainment. And for a computer game, it is less than 50 cents per hour. Compare this to a rock concert, $30, sports event, $20. Well, this really does make it pretty compelling for the consumer. And then at the same time, you've got this shift to digitization, which again is being accelerated by COVID, which is going to shift margins from 65% to 84%, because all of a sudden you are no longer having to send out physical cartridges or CDs to the shops. It's easier to buy and less marketing required as well. And then this is not to mention the optionality you get from esports or from in-game advertising, which we believe could be big, but for us, it's just a cherry on top. And then obviously, the big driver that we're going to see within the next few years is the console cycle. That, this is the last upgrade console cycle and probably potentially the biggest, where you have PlayStation 5 and the new Xbox coming out. And by all accounts, these are going to be cheaper, more affordable consoles than ever before. So that is just going to drive adoption. And then what has happened recently? Well, hey, guess what? Bookings are up 17%. FIFA Online 4 now has 30 million players. Madden has seen an increase by 140%. And The Sims, I don't know if any of you remember SimCity, that's got 30 million players now. It's just incredible the size of this. And look, we're buying this for a 5.5% free cash flow yield. Look, we are really excited about this and think this can go a long way. So that's it for me. And I'm now going to hand you over to Stefan Davidovsky, our new COO, who we hired during lockdown. So we've never actually met him in person. So yeah, well, I don't know that he's got legs, but I'll hand you over now.
Thank you, Aubrey. Thank you for your case studies and your analysis, and good afternoon to everybody. It's a pleasure to be here with you, and I'm sorry I can't meet you in person. To start with, I'll give you a brief intro about myself. Prior to Mayar, I worked at Mayar Capital Investment Management. That was a UCITS ManCo based in Luxembourg, Paris, and London. I was actually based in Luxembourg. I was only there for 6 months, setting up the investment management function for them. And I also took a regulated role there as a conducting officer. Prior to that, I worked for Eiko Research Investment Management, which is a Japanese long-short equity hedge fund based in London. I was there for 8 years as the head of head of operations and technology there. So some of the things I wanted to talk to you today are about our operational aims in 2020. And obviously I've started sort of halfway through the year. But the first thing really to address is the COVID lockdown and how that has changed the way that we function, and how it's changed the way a lot of companies function. You'll be pleased to hear, though, that for Mayar, we haven't come into any major issues, even though, as Aubrey said, I haven't met the team in person yet. But I think everybody's got very used to Zoom and other means to communicate, and it talks a lot about the team that we've been able to create a good rapport, and I already feel that I know the team quite well. So the other parts of the things that I've been doing since I started, I wanted to do a full review of the incumbent operational process. And again, you'll be pleased to hear that there is a robust operation in place. But Mayar has gone through quite a rapid growth in this year in particular. So one of the things I've been looking at is how to consolidate and automate processes to make the platform maybe a little bit more robust. The other part, a big part of what we've done this year, is the implementation of HedgeGuard. Now, from an investor point of view, why would you be interested in the fact that we've implemented HedgeGuard? So having a system, for me, is an integral part of investment management. It enables better data, clearer reporting. We have our own books and records that we can reconcile to our counterparties and administrators. So it's a pretty important piece. So what did we implement? We implemented the order management system, or the OMS. So that's pre-trade compliance, order release via fix, trade capture, execution review. The other part was the portfolio management system, or PMS. That is trade settlement, reconciliations, again, as I said before, to custodians and administrators, profit and loss, exposure and net asset value reporting, cash and collateral management, and lastly, compliance reporting as well. Now, why was HedgeGuard chosen? So for our needs, it has very robust core modules, but it is a system that is evolving. But for us, that we felt that was something that we were looking for, because we can influence the product's roadmap. And in fact, we've already started to run some collaborative projects with them. For example, we are looking at how to run an ideal portfolio that has a pari passu exposure management with individual portfolios parameters and regulation applied. We're looking at improving the order release to encompass multiple funds and counterparties, and also reporting templates for P&L and compliance. So another thing that we have been doing this year, which is a major piece for us, we are currently applying to the FCA for our investment management authorization. Now, why apply? Mayar Capital is currently regulated as an appointed representative of Privium Fund Management. So this means we're under their regulatory platform. But now that we've grown and the fund is getting bigger, we really wanted to bring these pieces in-house. So we think we're in the final stages of the application, but you're never clear when you're dealing with well, you are clear, but you're never sure when you're dealing with the FCA. So we're hoping at some point in Q3 we'll get the authorization, and at that point, Mayar Capital advisors will assume the compliance officer role, which again will fall under my remit. So I wanted also to briefly speak to you about operational best practice. When you think about operations, then I guess we automatically think about trade life cycle and technology. And I think having a scalable trade life cycle that manage the asset types that the business wishes to invest in is key. Obviously, technology is part of that. as the infrastructure that houses that technology. But I think also another part is communication between functions, groups inside and outside the organization. And I think Mayar does that very well. The fact that, as I said before, we've built quite a good rapport just using Zoom or Teams is sort of proves that fact. Another thing that we need to do is have collect data, have good data capture. Now, when you're looking at regulation and operating procedures, clearly regulation has a massive impact on how we as a firm operate. But this is only a good thing. I mean, regulation is there to give comfort to investors who employ an investment manager to manage their assets. So on top of regulation, how can Mayar give you comfort? Ultimately, our aim is to create an accountable and transparent platform that proves Mayar is performing its regulated duties with investor best interests central to the goals of this platform. So how are we going to achieve this? Well, transparent reporting, it's what the regulators require. It's what best practice bodies like AIMA have outlined and documented. And it's what you as investors need to make your own decisions. Working closely with our third-party partners to keep up to date and abreast of regulation requirements and changes. And then having clear procedural documentation and sound corporate governance behind this. I think this is something that is very, very important to the company, and we should be able to easily prove that what we say we're doing, we are actually doing it. The last point is building on the strong ethical culture within the firm. And I want to say to you that one of the reasons that I wanted to join Mayar was, it was soon apparent during the interview process that there's a strong team culture of mutual respect. And that was something that really appealed to me. And I think it's one of the reasons that you as investors are here too. So I'm now going to hand over to Sophie for the Q&A.
Yeah. Hi, Stefan. Thank you very much. And thank you very much to all the team. I hope you all found the first half of the meeting informative and enjoyable. We are now going to move into the Q&A session. So it's time for us to answer your questions. Mark is actually going to be leading this session. So as I mentioned before, if you would like to ask a question, if you simply press the raise hand button, or if you'd like to type a question, if you just pop that into the Q&A box, you should be able to see at the bottom of your screen. And we shall start answering questions in a moment. I'll hand over to Mark. Thank you very much.
Thank you, Sophie. While you're all thinking about questions and getting used to the technology to be able to submit them, just wanted to take another couple of moments to talk about ESG in practice. And, you know, you've heard us talk about ethics and ESG investing in terms of analysis and how we view the portfolio. But I just wanted to take a few moments to see how that has evolved over the last couple of years. Mayar's always taken a very pragmatic approach to ESG and engagement and what we believe we can achieve given our relative size. And in the past, that has been companies that have failed the investment process, failed sometimes the investment principle, sometimes the ethical principle. As you'll remember, to us, they're one and the same. And indeed, when conditions within a company have deteriorated, we've taken the opportunity to sell, really respecting the amount of difference we felt we could make as a smaller manager. However, in recent times, we've joined the Principles of Responsible Investment, becoming a signatory there. The aim of that is to formalise best practice across the asset management industry. But it also gives us the opportunity to collaborate with our peers, to amplify our voices in terms of talking to much larger capitalization companies, Alphabet being one example of that, where we collaborated with 20 or 30 different asset managers in attempting to engage with the Alphabet board on the subject of human rights. If you go to our website as well, we also have our ESG policy published there. That includes our voting policy, and it is our policy that where the mandate allows, we will vote on all matters in all geographies. The most recent you can see there is electronic arts, where we voted against the executive compensation package, and we'll continue to make our voice heard both in those proxy votes and as well as part of collaboration exercises, and we'll communicate those to you as and when they happen. ESG also has to, I think, run through the DNA of a company in its whole, rather than just in its entirety, rather than just in its investment process. One of the symbols of that is the gift that we've got for you this year. Last year, you'll remember, it was the reusable coffee cups to help save paper and plastic using disposable. This year, we have teamed up with a platform called EcoMatcher, which, as you'll see here, partners with foundations and smallholders across the world to plant trees. So through tree planting, the livelihoods of farmers are improved, and of course, carbon capture is something that is improved by that. And we've gifted you a tree. In the next few days, you'll receive a link to your tree. As a sales and marketing person, I'm always looking for metaphors and analogies, and of course, this time is no different. Your individual tree could be anywhere. It could be typically in a developing nation such as Guatemala or Kenya or Uganda, and just like we're dotted around the globe and coming together virtually, the Mayar Capital Forest is also coming together virtually as well. And you can actually, through that link, see your tree grow. Very much like the Mayar portfolio, I think if you look at it day by day, you won't see that much difference. But if you come back after 6 months or a year, you should be able to see significant growth and significant improvement in both the portfolio returns and the forest as well. So look out for that. I can see that we've got questions for the team. I'm just going to share in my screen, which is where the presentation is, so I'm able to see those questions. We've also got a number of pre-submitted questions as well, so I think I'll start with those. And I think the first is more based or more focused on macroeconomics and a more global approach, which is what is the Mayar view of global inflation or inflation across the major economies? I guess this is in some part driven by the fact that due to the pandemic, fiscal expansion and fiscal stimulus has been one of the main ways in which governments have tried to combat and mitigate the economic effects. So Aziz, you're currently on mute.
Right, thank you, Mark. Bobby, if you can also join us, please. So we've talked a lot in the past about, well, what I think is our inability to actually forecast any macroeconomic moves. I don't think it's our circle of competence. And we can share our thoughts, but frankly, my guess is as good as yours. I will tell you that I was surprised kind of coming out of the great financial crisis and this whole monetary expansion that we've seen in the balance sheets of central banks around the world. I was surprised that despite all of that, inflation remained very muted. So that was kind of, I think, something that I was, well, perhaps you think that would have gotten me to refuse to answer this question, given how wrong I was. But What I can say though, there is something different this time around compared to what we saw coming out of the financial crisis, which is this time around, we actually saw a massive increase in fiscal spending as opposed to just monetary expansion that we saw coming out of the great financial crisis. And so I just want to highlight that that is different, and it could be that that makes a difference between whether we have inflation or not, because it's potentially easier for the money to flow through, in a sense, to the real economy as opposed to financial markets when it's a fiscal expansion as opposed to a monetary one. And but on the other hand, it's also very hard to see how you can have big inflation with the level of excess supply that we have around the world today. So you may have a necessary but may not be necessarily sufficient condition to see higher inflation. But I mean, Aubrey will tell you, Aubrey has a great analogy. I'll let him say it. But the short answer is I've got no idea. My guess is as good as yours. If you look at long-term bonds, the market is saying we won't see any inflation anytime soon. But we shall see. Aubrey?
Well, I'm curious what this great analogy is now.
Think of bricks.
Yeah, well, the trouble with inflation is that it's like dragging a brick with an elastic band. Nothing, 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 and then suddenly you've got a brick in the face. Brexit. Look, I don't know. I can see structural reasons why you're not going to have inflation. I can see reasons why you should. I think the thing is, if you have a portfolio of great businesses, in the long run, it's not going to matter. But actually, if you do believe in inflation, equities are really the only place to be right now. Do you really want to own bonds if we have inflation? I mean, where they are now, I mean, wow. You know, any sort of form of fixed income, yeah, could be very painful. So, no, the answer is, again, I don't know. It's not our specialty, but if you do believe in inflation, I'd say equities are the least worst place to be.
Okay, and I think a lot of our questions will be COVID related, and this one's no different. To ask, what are the priorities in a post-COVID world? I'm not sure we're in a post-COVID world just yet, but when we are, how do your priorities look as a result of that?
Yeah, I think that's actually a very interesting question for two reasons. The easy answer is to say this industry or that industry, but I think the more interesting question is what you just said. What is a post-COVID world? What does that actually mean? Are we talking a post-COVID world meaning that COVID is gone? Or are we talking about changes that happen in multiple areas of the economy, our lives, and so forth, that are influenced by COVID that never go back to the way things were? And I think that is the more interesting question. Now, it's a much harder question, and I don't know the answer to that because we don't know what post-COVID means, to be honest. But I mean, back to what we said earlier about you have to be diversified. You have to be across several industries, but you also have to stick to your circle of competence and stay where you actually know what you're doing. And you're going to make mistakes. We all make mistakes. Investing isn't about being perfect. There's no such thing. But it is also about being diversified, being humble, and knowing that, if anything, that we should learn out of this year is the importance of being humble.
Thank you for that. On to the next question now, which is a little bit easier to answer because it's looking backwards rather than forwards. But just trying to understand what are the things you've learned over the last 8 months.
Okay. So I think one important lesson is I underestimated how quickly and aggressively things can change, especially in areas like public policy. I was very surprised by how quickly governments passed stimulus, but also how the rules were around what you can and can't do were changing all the time. And I don't think we saw that in the past. I think more fundamentally, the thing that is a more consequential lesson is that I think, at least from my point of view, I think we've just proven that as human beings, we are not ready to come together or unable to come together to solve the challenges that we face collectively globally. And so if you think COVID is scary, the climate crisis and what we see potentially happening, not potentially happening, it will happen. The challenge is there. And the only way to solve climate change is through coming together as human beings and working together as governments, as NGOs, as companies, as people. And I thought that we would eventually get to it. And I'm more skeptical that we will, having seen what happened this year. And the conclusion is fairly terrifying for the future of our children and grandchildren. I think if we're gonna deal with climate change the same way we've dealt with COVID, God help us. And I think related to that as well, and I think the outcome will come in kind of probably very soon, is the importance of addressing inequality. And I think kind of COVID kind of pushed things a little bit in terms of accelerating kind of things that were already happening for a very, very long time. But I think in many ways, COVID has exacerbated the inequality within countries and actually to an even bigger degree between countries. And so I think that's also a challenge that we have to solve as human beings to have a better world for children and grandchildren. I don't know, I mean, Aubrey, you may be more philosophical about these sorts of things than I am. Do you have any thoughts?
Thoughts on a post-COVID world? I don't know. I mean, look.
No, I mean the lessons from I think this year.
I mean, yeah, as you say, yeah. Perhaps actually the thing that's just shocked me is how I'll try and avoid being political, but just how incompetent politicians can be, and yeah. I mean, you know, other things I've learned. I suppose actually the thing that's been much more of a learning curve for me, or that has been much more informative for my learning, has been Wirecard. Yeah, that was so. There's a company that I was short when I was at Odie, what, 7 years ago, that finally broke, you know, a few months ago, and nothing to do with COVID, but just finally these things catch up with you. But here's the thing: risk management, the longs that I pretty much laughed at the time, if they employed successful risk management, they made far more money out of it than any of the shorts. And you know, I think that was a massive lesson in humility for me. That you know, it's not enough to be right; you also have to make money out of it. Now, look, if you're right enough, you're going to make money. But yeah, you need to. But I think, you know, a level of humility is required. Yeah, it's yeah. So I'm also quite glad though that one has broken, just because, I mean, that's a company that hacks my own personal emails. Yeah, and I got off lightly. Friends of mine been accosted outside their children's schools by that company. So Yeah, lesson learned. Another one. It's much easier to be long than short. Lot better for your health too.
All right, thanks guys for that. And I guess if we look in the portfolio, was there a big surprise this year in the way that something reacted or perhaps didn't react?
Well, I mean, the most immediate one is, and if you've seen the numbers coming out of Lowe's today and Home Depot yesterday, I am just absolutely shocked by how well those businesses have done the past quarter. We bought Lowe's in late March and started building a position there, and unfortunately kind of went up very quickly before we bought a lot, just because we were trying to average in. And then we sold it because it hit what we thought was the upper end of fair value, and it kept going. And now that we know how well the business has done in Q2, obviously, again, benefit of hindsight, we sold too soon, obviously. So that was a surprise. Obviously, not a very consequential one. Vestas, how well it's held up in terms of deliveries during kind of lockdown measures surprised me. I wouldn't have expected them to do so well. I think things like healthcare, whether it's Johnson & Johnson or LabCorp, not doing well in many areas of their businesses because people are afraid to go to the hospital. And I think I underestimated how much of a drop we'll see. I know in the UK you saw emergency room visits go down by half during lockdown. I underestimated how much you'll see of that. It turns out that people really didn't need to go. And I guess the biggest one, and this one is still unfolding because we don't know what's going to happen later this year, is how little Berkshire has done the past several months. They've been net sellers of everything. They've built up a lot of cash. Now, it may be that the market moved too quickly for them to do anything, but I would have expected them to do more than what they've done. And I guess it's too early to judge because we don't know what's going to happen next year and the year after. And who knows? Maybe they're right and everyone else is wrong. So we'll see at this one. But I was surprised by how little they've done. Aubrey?
Yeah, so similarly surprised on LabCorp and J&J. I suppose also slightly surprised by Nordstrom. Just how badly investors have taken it, because it does seem to me quite clear that as so much capacity leaves this industry, that can only be good in terms of market share. And especially when you look at some other terrible businesses, there are some really, really terrible businesses which are doing very, very well. Some businesses that clearly have nothing behind them. I mean, there's an educational business called GSX, which is up multiple times. And it's been proven that there is nothing there, that it's another one of these China frauds. And I can't reconcile in my head really sometimes how something like that, it's now got a market cap of 20 billion. How has it attracted that much capital when other good businesses, perhaps in our portfolio, have not? It is what it is, and I'm comfortable with what we own. So I'm happier with happier owning Nordstrom that's down 60 than something that's up.
Yeah, I mean, Nordstrom is a tough one because so far we've been right about its kind of industry position. It's massively outperformed its competitors, massively, not even close. But the whole industry has been a shit show. So it potentially is hard to do well when the industry isn't doing well, even if you're really good at it. So we'll see how it goes. Obviously, we've been wrong about the price this year, and now that we know what happened during COVID, but I guess who could have predicted? Back to you, Mark.
And I guess following on from that, given the surprises and the learnings, has there been any evolution or revolution in the investment process?
Well, I guess Aubrey talked earlier about the robustness and the importance of the balance sheet and things like that. So I will admit, I have never modeled in my life for a period of zero revenue. I never looked at a business where I thought that it's actually possible. Or not even zero revenue. Even a 90%, 80% drop, which we've seen in booking, for example, I did not ever conceive of that as a possibility. And because we've never seen anything like this. And I think that's one thing that we have done this year. So I guess that's something that we've changed. I mean, the other one, which is kind of still a work in progress, and I don't know, I still don't know a good answer to it, but what does it mean to valuation if you think rates are going to be near zero for the next 10 years? There are a lot of puts and takes, and obviously not all of the impact of interest rates goes straight into valuation, because the corollary to it is that you end up with lower growth in such a low interest rate environment, and it also means that inflation is subdued, so nominal growth rates of revenues have to be lower, et cetera, et cetera. But that being said, there's still a massive impact, at least theoretically, on valuations. And on the one hand, the link between the two historically has been very weak, between interest rates and actual equity valuation. On the other hand, we've never had anything like this. And we've never had anything like this potentially lasting as long as this. So I don't know. It's one that Aubrey and I talk about all the time, and I don't know that we've figured it out. Aubrey?
Yeah, I mean, as you say, we have never seen anything like it, and perhaps one slight difference is that whilst you could say, look at Japan and 10 years ago, we have seen negative rates before, or we have seen really low rates before. We haven't seen it globally. And this, I think, is a big difference, that there is just nowhere for money to hide and generate any form of return whatsoever outside of equities. Yeah. So I think that is a very, that could have a very profound impact on what valuations should be. But that's difficult. As you said, process is also absolutely sort of been updated to really reflect much more focus on the balance sheet and security there. And then so there've been a few sort of gradual improvements or sort of evolutionary improvements to the process, the checklist. There's a lot of work that we're doing on base rates at the moment, and how we and more a sort of technological issue within Excel and within Bloomberg, how we can view base rates and therefore better establish what normalized earnings for various businesses ought to be. But maybe we can leave that for another time, because that can get quite geeky there.
Well, I suppose given those improvements and enhancements, and the fact that we're focusing on base rates, etc., what's the most fertile ground for new ideas as a result?
I think the market this time, the recovery that we've seen the past few months has been very narrow. So actually, the median stock in the US or Europe hasn't recovered as much as the index, not even close. Because it's been narrow, there are many industries that have gone way, way above what we're willing to pay, and many others are still fairly reasonable. So it's my first slice, and again, we're not kind of making a big macro call. We're just talking about where we seem to find ideas these days. Is more around industrials and more cyclical names, as opposed to, on the one hand, as opposed to the other extreme being more stable dividend paying stocks. Europe more than the US, for sure. And then more kind of philosophically, companies where there is an uncertainty about the timing of things, as opposed to whether something will happen, seem to be punished a lot more than normal the past few months, and many haven't recovered. So, I mean, Aubrey talked about the home builders earlier. We've seen the US recovery in home builders being so strong, and Toll Brothers just being the best performing stock this year. But the UK builders have actually not done well, even though both Aubrey and I are very confident that 5 years out, they present a terrific investment opportunity. But there's a lot of uncertainty about the when, as opposed to whether something would happen. Aubrey, I don't know, where have your ideas come from recently?
Well, certainly if we look to the future and where ideas are coming from, as you say, that sort of quality cyclicals, I think, is proven quite fertile. I mean, but the thing is, it is much, much more difficult than your Nestle's and your Unilevers of the world. You know, when you are looking at quality cyclicals, trying to really think about what normalized earnings looks like is, it's much more difficult. And hey, that's what you pay us for. And
we now actually have to work.
Yeah. But I think the thing is, people dismiss cyclicals as being low quality because of the variability in earnings. But actually, I'm sort of reminded of a fractal that yes, you actually probably have the same variability just over a different time frame. That the earnings of Brenntag are just as stable as the earnings of Unilever if you just look at it over time frame. If you extend it, all of a sudden the amplitude looks really ferocious at the moment, actually doesn't look so bad over a very long period of time. And you look at companies that we own, such as Brenntag, and we've actually seen the quality there really sort of play out. And so for us, the secret is how do we really think about normalizing some of these cyclicals, and how do we separate the wheat from the chaff? And it's and there is that's, I think, where a lot of our ideas could come from. And yes, Europe, as you say, I think European industrials. I mean, one thing that has sort of been just playing through my mind is that we have these huge multiples attached to software businesses that have, and we are assuming that these software businesses create so much value for their customers, and they do. We know they do. We bought SAP because they do create that much value. But here's the thing: they can't take all the value for themselves. Microsoft, SAP, Salesforce, they cannot take all the value for themselves. They have to give some value to their customers. And if the customers are going to receive all that value, then, their multiples do not imply that they're going to get any value from it. So I think there is, a lot to be looked at. But as I say, distinguishing the good from the bad can be is much more tricky.
Okay, and we spoke a little bit, well, probably a little bit more than usual about ESG. What's your assessment of the biggest ESG risk in the portfolio, and how we got comfortable with that risk?
So I think there are two positions that we own that probably have a higher ESG risk. The first one is one we've talked about before in this context, which is Alphabet, parent company of Google. And it's something that we've been worried about for many years, to be honest. And I think it's the reason why for many years it was trading below what we think it's worth, and I think that will continue to be the case. So I think the shape of how this plays out, I think is very unknown. But we're definitely starting to see in the past few months and maybe even the past 2 years, that there is a bigger movement towards regulating these technology companies. And while we think that the risk in Google is lower than some of the other ones, like Facebook, for example, that's not to say that the risk isn't there. And the only way that the way we dealt with it is that we've been much more kind of stricter about when to sell it as it gets kind of upper in valuation, closer to what we think it's worth, kind of demanding basically a bigger margin of safety there. And then sizing it, if the risk wasn't there, a company that's growing as fast as Google, that's been trading at some of the valuation that it has the past couple of years, would have been a much, much bigger position than it is now. But the risk was there and is still there, and probably will be for quite a while. So that's the first one. The other one is Samsung, actually. That's kind of a governance risk there around the family. Now, current chairman came out not that long ago and pledged that he's going to be the last member of the family to run the company. But to be honest, Elliot got involved a few years ago when we started buying it, and we thought that Elliot would kind of force their hand, pun intended, to if you know anything about Elliot, force their hand to actually change their ways, and they have. I think at least I underestimated how slow the process would be. So it's still happening, improvements are happening, but at much lower pace than I would like. Aubrey, do you have anything to add?
Not really. The only thing I'd say though is, as with all risks, the biggest risk is the one you don't know about. And hopefully when we find such risk, we're able to deal with it quickly.
Okay. We've got some questions that have been submitted post the presentation.
But by the way, Mark, and everyone, you can raise your hand. There's a button that says raise your hand if you want to verbally ask a question. If that's easier for you.
Yeah, I don't see that at the moment. We've got some questions from the floor that have been typed. So I'll keep them anonymous unless you really want me to give you credit for that. You can do that in the Q&A. But so with regards to the acceleration in AUM over 2019 and 2020, is there anything specific you want to talk about there? And I guess the natural conclusion of that is, what is the strategy capacity? Okay.
So to address the first question, it's basically what Stefan was talking about earlier. And we started investing in technology last year, kind of ahead of the growth curve. And then also just hiring a chief operating officer earlier this year, also ahead of the growth curve, was preparation for the increase in AUM. And it happened much faster than I thought this year, given COVID. But I think we were already thinking about accelerating our investment ahead of AUM growth anyway. So we haven't had any difficulty as we are now. But obviously, we need to continue to invest. As we grow AUM, we need to hire smarter people, more people as needed, invest in technology, and continue to have a robust infrastructure to make sure, especially on the operations side. Actually, I'm answering this mostly from the operations side. On the operations side is the one where we really need to continue to invest as we grow, and we will. Now on the investment side, which is obviously the more important one for the strategy capacity bit, our average holding period is more than 5 years. I think it's ticked a bit longer actually the past 2 years. So there are a lot of things that we've owned since inception, and our median holding is probably closer to 6 years or so right now. And the majority of what we own is very, very liquid. So the combination of both allows us to actually deploy pretty big amounts of capital into what we do. Now, it depends on the form and when it comes. So if you gave me $1 billion tomorrow in the fund, I'd be able to deploy it no problem whatsoever in the existing positions. If you gave me $10 billion tomorrow in the form of 100 different SMAs, then it may be trickier. So I think in general, the strategy capacity is well, at least in the low single digits $billion. It can grow bigger as we invest more on the investment team, for example. But also the other question is how quickly it comes in. But I'm very comfortable going at least 10x where we are today with no issues in a fairly short period of time. So if someone has that kind of money and wants to send it in tomorrow, don't worry about it.
Okay. I'm just seeing the question. No one's reacted to that invitation just yet, but I'm sure they will in a second now. In the meantime, we saw the cash level chart had gone up from the March lows. Does that mean that valuations are getting stretched and the fund is booking profits in some of those positions?
I don't like to use the word booking profits. It seems like I hate selling anything. I'd rather buy something and hold it for 10 years or hold it forever for that matter. It makes my job a lot easier. So I don't like to book profits. But we do have valuation discipline, and we do have pre-agreed levels at which we start to trim a position or completely exit it based on valuation. And I think it's obvious that the opportunities today are not the same as they were on March 23rd. I mean, we never got actually fully in. I think we got to about 3% cash in first week of April before the market started to recover. So yeah, absolutely. Things are not as attractive today as they were in March. Are we still finding things? We're still finding things. We've added to a few of our existing ideas this quarter. We're looking at a couple of new ideas as well. So, I mean, as we mentioned earlier, there's still some fertile ground out there. But yeah, it's not, I wish March 23rd opportunity set is what we always had, but you only get these every few years, and you got to be ready to put your money in very quickly to take advantage of it when it comes. But the rest of the time, you're going to have what we have now, where you find opportunities every now and then. Luckily, we only own 20 to 30 positions, so we only really need a handful of positions every year or so to be able to continually be invested.
Okay, we've covered sort of opportunities after the recent rally, I guess, unless you want to say a few more words about that. But specifically the technology sector, which has seen a strong rally in the last 3 or 4 months. And I guess this speaks to what you were saying earlier about the rally has been, to some extent, quite narrow.
Yeah, I mean, I wrote a little bit about this in my second quarter letter. On the one hand, and at the top level, it's hard to see how the valuation of many of these companies makes any sense. But I don't think it's across the board. I think I'm willing to accept that Microsoft, for example, is actually fairly valued today and not overvalued. We sold it purely on valuation, so we think it's expensive, but I'm willing to accept that it may not be, and I'm wrong about valuation given everything we talked about around rates and around kind of this post-COVID environment. On the other hand, some of the worst businesses with the worst balance sheets, certain companies that make electric vehicles and such, I don't know. I mean, I've been wrong about Tesla for many years. I don't think it's necessarily worth zero. I think the current valuation is nuts, but I've been saying that for many years and been proven an idiot. So I'm just going to double down on it and continue to say the same thing.
Well, we have had a question on this just come in, and I'm sure I know this is something in the Brocklebank family has been a matter of bone of contention. But do you see electric vehicles picking up, and would it be a good investment during the next few years?
Actually, yes. I think electric vehicles are definitely the future. But well, I won't say definitely, but I get the case for electric vehicles. Funny enough, it was an oil executive that convinced me that EVs were going to be the future, when he was explaining to me that the problem with electric vehicles is that you just don't have the infrastructure for it. And I looked outside and looked at all the street lights and just thought, okay, you're wrong. And sure enough, just the other day, down the road from our office, there are now streetlights which double up as charging points. So yeah, I think they are the future. But does that make them a good investment? Well, maybe within companies such as Honda, BMW. I've just seen the new sort of iX. There's a link to that I saw. Looks like a great car, range that exceeds Tesla's. The Ford, what's it, Mustang E or whatever it is. That looks like a great car with a range similar to Tesla's. I mean, one of the things I love about Honda is that they're actually going to a slightly different route. They're doing smaller vehicles which have really small batteries that can, swap in and out. Because Honda really is a bike company rather than a car company. And so yeah, there's a huge future for them. But trying to pick a winner, especially in the car companies, is really difficult because you've also got the legacy businesses which are going to suffer, and then also working out what are the economics of of a new car going to be, and maybe the answer is actually go and buy a semiconductor business which is trading on horrible multiples because they're going to have 10x the number of chips in an electric vehicle than in a current car. But if the question is, do I want to invest in Tesla or Nikola, whatever, no, I mean, aside from valuation being ridiculous, if you want to know about Tesla, go and look at Tesla charts and look at the abuse that this guy has received from Elon Musk. I think Tesla there is something rotten to the core there. And I won't say any further, otherwise I'm going to get wound up and my blood pressure is going to rise. But as you say, this is This is a bone of contention in my family. I've got one cousin who is at long Tesla, and he used to be an analyst at an American fund, and another cousin, Dan, who's a value investor who is more sensible.
You mean the one that's right?
Yeah, exactly. But yeah, yeah. So in short, yes, it will be, but just probably for someone else.
Okay, we're coming to. We've got a few questions to answer on the text submission. I'd just like to remind people, if they do have a question that they would like to talk to, just remember you won't be on screen. So if you are attending this meeting in your pajamas, your secret will be safe with us. I can assure you of that. But in the absence of those, we'll just answer the last few questions, which we've got two on a macro basis here. The first is looking at the European exposure of the fund, which is quite skewed towards the UK. And although the process is, as we've mentioned, bottom up, country allocation is the result of that rather than the input. It'd be interesting to see if you have a macro view on UK versus continental Europe in a post-COVID context. And we've already spoken about, we're not entirely sure what post-COVID means yet. Just wondered if you had any macro views on that.
Well, I want to highlight that half of that UK exposure is Unilever and Ashtead. Ashtead is listed in the UK, but it's mostly a US business, or the biggest part of it is a US business. And then Unilever, we own the UK PLC shares, but obviously the UK is a small percentage of that. So those two kind of make a big part. They're the biggest two in terms of our UK exposure. After that, we own PZ Cussons, which is a consumer products company, which actually has two big geographies, Europe and Africa, with the African bit being mostly Nigeria. So that's a very big, very non-UK business to a great degree. So the big exposure to the UK economy in our portfolio is the home builders and Howden's joinery, and we think we're not very again, we're not making macro calls, we never do, but what we see, at least from the companies that we invested in, is we do think housing is a great place to be in the UK, outside London especially, and then they come a similar thing that's happening in terms of the industry cycle itself with Howden. So so they're both kind of based on our understanding of where the industry itself is, as opposed to a specific bet on kind of a post-COVID, post-Brexit UK. Obviously, if things get really ugly, those ideas may not work or may take longer to work. I don't know, Aubrey, do you have thoughts?
Well, I guess, we have a slightly higher UK exposure, or we certainly run the risk of having a higher UK exposure simply from availability. That it's much easier for us to understand businesses like Howden or Dunelm that we used to own when you can go and visit them and you can see what they're like. It's, if you want to own a retailer in Poland, it's going to be a lot more difficult for us to actually really understand the culture, understand what the offering is, what the differentiation is. It's just more difficult than it is to understand something that is on your doorstep. So, that doesn't mean to say we're going to own it because it's on our doorstep, but our understanding of it is going to be better because it's on our doorstep. So, when they do become good value, it's easier for us to buy them. So, which is perhaps why we've got, why things like Dunelm and Howden's, and maybe not something in France or something where we just don't understand the culture as well.
And I think also the UK market, because of Brexit, has been kind of down and cheap for a couple of years, even pre-COVID, compared to something like the US market or other parts of the world. So just purely on valuation, slightly likelier that we're going to find something we like in a market that's cheap than in a market that's expensive. But so I think that plays into it. But yeah, I doubt we'll be making a strong bet on, if we had to make a strong macro bet on the UK, I think we would be, to start with, it'd be certainly outside our circle of competence, but also be harder probably as a bet to make.
Okay, we've been asked, this is an election year, it doesn't say which election, whether it's my local council elections or US presidential elections. Let's assume it's the latter. How will either outcome affect the portfolio, and what are you doing about it?
Well, I mean, we've always talked about our third partnership principle being long-term only. So we're always thinking 5 years out and kind of discounting to today and trying to figure out the returns from the point of entry until 5 years out. As a rule, believe it or not, elections don't matter. I mean, if you look at history, over the long term, they don't seem to matter. And over the short term, there is no pattern to how they matter. And it's hard enough trying to predict businesses and industries that get into the much harder game of predicting politics. I think as political predictions are there to make economic predictions look good.
I think we're going to go back to the final questions now and go back to some more micro topics. Apple was sold in Q1. What was the reason for that?
Well, valuation, again, we thought it was fully priced at the time, and this was in January actually, and before we thought COVID was going to be a global problem, COVID was starting to become a local Chinese supply problem. And we didn't think that the combination of China shutting down Wuhan and its importance to the supply chain, in combination with Apple trading at an all-time high valuation, made any sense. Obviously, with the benefit of hindsight, we were wrong about how high the valuation can get because it's rallied since we sold it, even though it dipped a little bit during the sell-off. We always say that we've got no FOMO. I mean, I actually have it here in my drawer. So it's you can't have fear of missing out. It's a terrible way to make decisions. You've got to stick to your process, and it was expensive, so we sold it. Similar to what I said about Microsoft, I'm open to the possibility that some companies, Apple included, could be fairly valued in this environment, and we were wrong with that valuation. So, but it's not what we do.
Okay, and going to more sectoral views that have been really suffering over the year to date for reasons that we all know about, namely travel and hospitality and commercial real estate.
So the first one, I guess we do have a view because we own Booking.com, right? The way I think about it is that if you had a spectrum in terms of risk in kind of the travel and hospitality industry. On one end, you would have airlines, especially the big legacy ones, where you have massive operational leverage and massive financial leverage. And on the other end of that spectrum, you have something like Booking.com, which has a relatively a flexible cost structure in the short term, and a very flexible variable cost structure in the medium term. And we've seen that kind of this year, their ability to take out cost in a matter of a couple of months has been unbelievable. And they've got the balance sheet in terms of cash to secure that. And depending on how strongly you believe the recovery will be and how long it will take, you should bet on at one point in that spectrum. So for example, hotels like Marriott and Hilton or whatever, they're going to be somewhere in the middle. The ones that own more of their properties, they're going to be closer to the airlines that are ones that depend more on franchising, are going to be closer to Booking. When we looked at Booking in March and early April, we decided that we had no idea how quickly travel is going to recover. And we looked at multiple kind of versions of the world, including ones where travel doesn't recover for many, many, many years in the absence of, it was kind of the worst case scenario where you have no vaccine, no treatment, and a fundamental change in behavior driven both by psychology and economics that really makes recovering back to 2019 levels many, many, many years down the road. And then we looked at everything in between. And with airlines, if things don't recover within a year or two, it's very hard to see how, as an equity owner, you don't get massively diluted, either through issuance of more equity or through the issuance of a lot more debt that has to be paid back out of future free cash flows. And in either way, kind of that clock ticking makes the investment worse and worse as time goes by, to a much greater degree than something like a Booking.com. And so we played it conservatively and chose to go to the other extreme. Granted, Booking was trading at much lower levels than it is now, so it may not necessarily be the best place to be on that spectrum, but I think the going to airlines, for example, was definitely in the too hard bucket and a much higher risk investment that we were willing to underwrite. On the commercial real estate, and then I'll hand it over to you, Aubrey, if you want to comment on this. I have no idea. I mean, I can tell you we just renegotiated our office lease this week, actually, and got a much, much lower lease than we had. Our building here is probably 30% empty, I want to say. And just talking to people, the few people that have been around back at the office, I would not be surprised. I mean, every other day, there's a truck outside and a company leaving. I would not be surprised that it's half empty within a few months. So at least in the short term, it's going to be really tricky for commercial property owners. Will there be a mass exodus from offices? I personally don't think so. And I think once the kind of the acute COVID situation is resolved within a year or two or whatever, I think people will be surprised by how much we go back to the way things are. If you want to look at how different companies have been dealing with this, go and search Twitter versus Amazon. So Amazon has been massively investing the past couple of months into new office space. And they think that they're going to bring everyone back to the office as soon as this thing is over. And they believe that it doesn't work as well from home. And then Twitter basically told people you can all work from home indefinitely. Facebook has done something similar, though not to that extreme. It's very hard to tell where it falls, but I'm not in the camp that everyone is going to start working from home and nobody's going to want to go to the office ever again. I think people will go back. Companies will have to probably be more flexible about working from home under different days of the week and different conditions or whatever. Now that the technology, they've invested in the infrastructure to make it possible anyway. So that allows them to do it. And it's proven that to a great degree it does work. I don't think it works long-term, but I think in a short-term capacity, mixed with some office FaceTime kind of, it probably works. But I don't know where it falls exactly. And again, this is an industry that's both operationally and financially levered. And so even a small change can have a massive impact on the outcome. Aubrey?
Yeah, I mean, you know, pretty much similar sort of thinking. I guess the only thing I can add really, you know, in terms of the commercial real estate is that it just seems to me that the risk reward is very skewed to the downsides, because certainly operationally, because you can't get above 100% capacity. I really struggle to see any price increases happening in this environment. But as you say, there is huge pressure to the downside, and for how long, we don't know. You know, so I think there are just better opportunities elsewhere. Why cap your gains with unlimited losses? And they are pretty much unlimited with your, well, you can lose everything when you're levered as highly as some of these things are. When you could own something like Unilever. And then travel, I think really that it's just going to depend on how long it takes for this thing to finish, to be over. If Russia has a vaccine, and
I'm sure they do.
Yes. Sorry, let me rephrase that. If Putin actually has a working vaccine, then it could be over very quickly. And in which case we go back to our normal lives. But if it takes 2 years, then the changes that happen become more permanent. So people are buying a lot of RVs, recreational vehicles. A friend of mine in America just said he saw driving down, I think the I-10, and he saw every fifth car was an RV. And if that's the case, then you know that is going to have a big impact, because when people make capital expenditures, when buildings are built with this in mind, the changes there are very long lasting. So it really will depend. But from what we do, we buy things like Booking, where it's not, where they can win in any environment.
I think I want to add one more thing on the travel bit, which I forgot to mention, which is certain parts of the travel industry are much more exposed to a much greater degree than you'd think to business travel. Big legacy airlines, for example, and certain types of hotels and hotel chains. And I can see a much bigger impact on an ongoing basis on business travel than I do on leisure. So if I'm thinking many years out, I'm willing to accept, or I'm not going to say predict, but at least accept, that business travel will fundamentally be reduced for a very long period, structurally be reduced on an ongoing basis compared to leisure. I think the case for flying halfway around the world to attend a board meeting is much weaker than taking a holiday by the beach. And I think people have just gotten used to using Zoom and things like that, which again, I'm not saying it's going to completely replace business travel, but I can easily see how it reduces it by 20, 30%, maybe even more. And I think that hits certain parts of the travel industry more than others.
Okay, well, I think that brings us to the end of the questions. We'll hand over to Aziz in a second for some closing remarks, but I'd like to extend my thanks for all of you joining today without the added incentive of, which is normally a very nice reception afterwards with tea, coffee, and some nice cakes. So in the absence of that, thank you very much. A reminder that the email link to view your tree will also be in your inboxes very shortly, and a broader thanks, I think, that, and I'm sure Aziz will cover this as well, to our partners who've stuck by us this year and been able to believe in us. We really do take that very personally, the honour that's bestowed on us by that, and so thank you very much from behalf of everyone in the investor relations team as well. And Aziz, I guess it's for you now to wrap this up.
Well, again, like Mark said, I want to thank you all. I want to thank you all for not just attending today, but all the support that we've gotten from you this year. It's been a crazy year. It worked out so well in the end, I think, but there were definitely tough periods for all of us. And the words of support that we got throughout this period, just people picking up the phone or sending in a message or email, that really made a difference to the team and to me, and then I really appreciate it. So thank you so much for that. And I'd also want to thank all our operational partners. They've been tremendous. It's been, I'm sure, tough on them. Our brokers, banks, custodians, administrators, back office and middle office providers, the legal team, compliance, Privium. It's been a challenging year for all of us, and we wouldn't have been able to achieve what we've achieved without you. So thank you so much. And finally, I want to thank the Mayar Capital team. Every year, as they make my life easier, they end up doing more of the work so I don't have to. So I'm very grateful to them. I think we have, I always kind of, some days just think how lucky I am to have a team like the team that we have at Mayar. And I genuinely am grateful to all of them for their hard work. It's also been a tough year for them, dealing with working from home, kids, and all of that. So thank you all for that. Thank you for kind of taking care of our partners, and I really hope that next year we can do this in person like we used to, and maybe we do more things virtually like we did in March, I think, and now it seems that a lot of people have liked that, so maybe we'll do more of that. But I do look forward to the day that we're back in the same room, shaking hands and hugging maybe, and kind of living life like it used to be. Have a good evening, everyone. Thank you for joining us today, and stay safe and take care.